Good morning, everybody. Today is Tuesday, December 10th, 2013. I want to thank you for tuning in. I just want to say I apologize for being out of the loop for the last month. With everything going on with my wife, it's taken a lot, but I want to say thank you to everybody who's sent cards and emails and called. It's really humbling. Thank you very much, and we're going to get through this, and your help and prayers are helping us as well. And I'm very humbled, and thank you so much. Moving forward to the markets and the economy, a couple people have asked me, Dan, why have the markets done so well this year? And it's the same reason they did well in 2012, and it has to do with the Federal Reserve stimulus program, because it's not growth that is driving stock prices right now, it is the Federal Reserve. The Federal Reserve is doing two things. They're keeping interest rates artificially low, which is moving stock prices artificially high. And now we're at a point where the Federal Reserve is really considering lessening the amount of stimulus they add to the economy. Now, if we look back at 2008, the Federal Reserve came out and did something that was unprecedented. They stimulated the economy with $780 billion. Well, if you look at 2013 and 2012, we're doing more than that. We're doing $85 billion a month, which is equaling close to $1 trillion a year of stimulus. That is crisis mode for the last 5 years, and that's what's kept the rates low, and it's pumped up stock prices. However, we're at a point now where it looks like they are at a time where they finally have to stop with the stimulus. Now, or not stop, but they have to lessen it, because the effect of it is where all they're doing is pumping up prices. It's not adding growth. And in fact, Morgan Stanley and Morgan Stanley, Merrill Lynch, Goldman, they've all lowered their growth forecast for 2014. They did the exact same thing a year ago, and the charts show that growth has slowed, but stock prices remain elevated because of the Fed. Now, what do we do about it as investors? And moving forward, there's two things to look at. We want to look at, number one, how are we going to be affected with rising rates? What are we going to do to invest in that? And one of the things we're going to do is look at bank stocks. Bank stocks traditionally do well in rising interest rate environments. We're going to keep our position hedged against the 10-year bond. So if the 10-year bond prices rise, we're going to be okay. And then finally, I'm going to add floating rate bonds to the portfolio. Floating rate bonds will give us a yield, at the same time not hurt us if interest rates go up. If you look at treasury bonds this year, anybody who's owned treasuries has lost about 20% of their money this year, because as rates rise, the value of treasuries go down. It looks like rates are going to keep rising, which is why we have no exposure to treasuries except on the short end. So as they rise, we are doing okay. And at the same time, we own bonds overseas, which are producing higher yields. That's the plan for 2014, and obviously, unless something changes. The last thing I want to look at, I think it's going to be a very good year for natural gas, and I do plan on adding a little small natural gas position, because I do want some commodity exposure. We just haven't been able to add any commodities in the last year, really since September 2012 is the last time we had commodity exposure, because commodities have just been on a down, just going down because there hasn't been the growth. But natural gas looks like it's one area of the commodity sector which is going to do well, and I do want to profit from it. So with that, I want to thank everybody for tuning in. Again, thank you so much for the support, and have a wonderful Christmas. I will reach out to you by the end of the year, and happy Hanukkah to everybody as well. And thanks so much. Have a great day.